You want to know what are the best stocks to buy now? I got you covered with 7 stocks that I think are attractive right here and lower. And as a bonus, I'll share several picks from community members for you to explore. First stock, when we're investing in secular growth trends, we're looking for best of breed companies, especially in the cloud SaaS universe. So when you think of CrowdStrike, you think of best of breed for cybersecurity. Now, one topic that's not quite as sexy is going to be HCM, human capital management. And when you're thinking of best of breed for enterprise, there's one name that does stand out, and that's Workday. So enterprise management cloud, finance, HR, planning, spend management, and analytics. 10,500 global customers across 175 countries, serving over 60% of the Fortune 500. 65 million plus global users with 95% customer satisfaction, and almost 20,000 employees worldwide in 30 different countries. Now, Workday is going to be more of a mature growth company. You can see here 18.3% year-over-year growth, and the stock has sold off after earnings with concerns about future growth. So headline, Workday dives as Wall Street debates sales slowdown. And the stock got absolutely hammered, 12% after earnings. And you can see the earnings here. They weren't really that bad. This is about guidance and just that slowdown. Non-GAAP EPS, $1.74, beat by 16 cents. Revenue, almost $2 billion, beat by 20 million. The Q2 outlook, subscription revenue, $1.895 billion, representing growth of approximately 17%. And that non-GAAP operating margin, 24.5%. You can see on Seeking Alpha, the profitability metrics are strong at an A. Growth B+, you can see that forward revenue growth is slowing down here. It's showing 15.98%. Valuation, it's going to show a D+, but this is going to show the PE ratio. This is one of those SaaS companies, software as a service with recurring revenue. So even though that forward non-GAAP PE, 31.82, that's not really that bad. We have to look at those SaaS metrics specifically. So the EV NCM revenue for Workday is just over a 6x. Now for comparison, CrowdStrike is around a 21x for the same metric. And I'm not saying that Workday should have a 21x, but it's just for comparison. Better comparisons for Workday, of course, would be Paycom, which is around a 5x, and Paylocity, which is about a 5.5x. So Workday is going to carry a higher premium on the valuation, but rightfully so, because Paylocity and Paycom both focus more on SMB, small and mid-sized business. Workday is much more focused on those larger enterprises. The rule of 40 for Workday, you want that 40% or more. We're at 44%. And free cash flow percentage, 26%, not bad. Workday is still well positioned to capture growth in back office software over the long term with several drivers for growth, including cross-selling. But the macro issues that caused the company to cut its guidance are likely to persist, at least in the near term. If you're a long-term investor, this could be an opportunity. This Mizuho analyst has a price target on Workday of $280. And it's trading right now at $215. You can also see KeyBank analysts, the target slashed from $330 to $275. Oppenheimer, price target $300 from $320. From an investor standpoint, Workday is stuck in the middle and is not growing super fast as its margins are not seeing outsized improvement. Again, this is more of a mature growth company. And while the stock is now cheap enough and it doesn't seem to be a lot of downside risk, nonetheless cut the price target to $270 from $305. So you can see the stock sold off hard after earnings. You do have this gap down. You're below the S3, below the moving averages. Really, the technicals are broken at this point. It could bottom soon. It's not showing solid signs quite yet, although you do see a little bit of green here around $215 a share. I wouldn't be surprised to see Workday below $200, and that's where I'd really be interested, is below $200 DCA. But I do think this is attractive right here at $215 DCA, and that's assuming a long-term investment of 5 or more years. Now, I've been investing for 25 years, and one of the most polarizing stocks I've seen in my career is Tesla. And it really comes down to that question. Is this a car company or is it a tech company? Now, a lot of people are going to say it's a car company. A lot of people are going to say that it's a tech company. What's interesting about that is every time I watch CNBC, they always say that Tesla is a car company. But then they'll talk about the worst performing tech stocks, and Tesla is on that list. So which is it? A quick story here. I've got a friend from college, and he's a mechanic, and 2-3 years ago, he came and visited me. And we had a conversation, and he told me that he would never own a Tesla. He thought electric vehicles were a joke, and it would take many years before people adopted electric vehicle technology. Here's a text that I'm going to read directly from him word for word. I've had a Tesla Model 3 for a month, and it's hands down the best car I've ever owned. I like it so much that we just bought a Model Y for my wife. I have no gas vehicles now. If you would have told me that a few years ago, I would have laughed at you. The Model 3 is a good car, and when you add the cool tech like FSD, it works great. It's totally the best car I've ever had. Looking at it right now, this stock is down about 12% in the past year, where most stocks have been ripping like Nvidia. Year to date, the stock's down almost 30%, and the 52-week low was $138.80. 52-week high is $299. Now, I've been telling you I like Tesla 175 or less DCA, preferably 150 or less DCA as a 5-year investment. Looking at Morningstar, which is typically pretty conservative, they have a fair value of $200 on Tesla stock. It's a 4-star ranking. Morningstar says it has an economic moat rating of narrow. A lot of people would disagree with that. Morningstar also has an uncertainty rating of very high. So very high uncertainty, narrow moat, yet $200 is the fair value estimate. Morningstar forecasts Tesla's deliveries will be slightly higher in 2024 than the 1.81 million in 2023. Morningstar also forecasts lower average selling prices to deal with competition, and they forecast automotive gross margins to be 19% in 2024, in line with 2023 results. Excellent balance sheet. So cash and cash equivalents, $26.9 billion at the time of this article. Total debt, $4.8 billion. So Tesla is going to be a lower margin business. But if you're a bull, you're thinking about things like FSD. That's going to give recurring revenue to Tesla. And if you've been following this story, Tesla has significantly cut FSD down to $99 per month. There's also opportunity for Tesla to sort of lease this out to other car manufacturers. So a Ford or GM might use Tesla's technology for full self-driving. Then, of course, you have to take into consideration solar, battery storage, the Tesla charging network, moonshots like Optimus, which I don't even factor in when I'm trying to put a value on the stock. And then, of course, what about the $25,000 car?
But he's going to open plants all around the world for low-cost cars, and wait till you see what's going to happen when all of a sudden they start selling cars instead of for $40,000 a piece, for $25,000 a piece, which is going to happen in about a year and a half from their new model. The new model, they think, is going to do 5 million cars a year. 5 million cars a year for the Model 2. That's coming.
So you can see Tesla bottomed out around mid-April, $138.80. It's bounced off that nicely, trading right now at $177. My preference would have been to be adding heavily. In fact, this circle was my primary preference, thinking it might even go lower. But looking at the momentum now above the 50-day and looking at this R3 up here at $233, that Morningstar fair estimate of $200, I think the stock is probably at least a $200 stock. Could the stock sell off next earnings and go back down under 150? I think the answer is yes. I'm talking about a long-term investment, 5 years or more. I still think $175 or less DCA, which is what I've said for months, is the area to add the stock. Now, Shopify could be considered a spec stock for many of you. Some people might even call this a meme stock, but the reality is this is a legit company. You can see $1.9 billion in revenue Q1 2024. Now, that's 23% year-over-year growth. Of course, we'd like to see more growth than that, but Shopify holds over 10% of the US e-commerce market share, and they expect further penetration. 675 million plus unique online shoppers purchasing from Shopify merchants in 2023 alone. And of course, millions of merchants in 175 plus countries. So Shopify started out really simply online 2006, and you can see how it's evolved to today. Brick and mortar, marketplaces, social, pop-ups, B2B, and continued to expand the products it offers: apps, marketing, analytics, cross-border platform, order management, back office, shipping, and more. And some huge brands use Shopify. You're talking about Nike here, Mattel, Ashley Furniture, Nestle, even Mr. Beast, YouTube's favorite.
I'm going to show you how to start a business on Shopify.
And this is a great snapshot right here showing the innovation that Shopify really offers. Check out some of these numbers for Shop Pay. This could be a huge growth driver in the future. Up to 50% higher conversion when Shop Pay is used. 150 million plus buyers opted into Shop Pay. 141 billion, that's cumulative since launch in 2017. And this $14 billion number is up 56% year over year. So not only e-commerce, but also a fintech play. Profitability on Seeking Alpha, it gets a B. Growth, A+. It shows forward revenue growth 22.32%. Valuation, it's not cheap. This stock has a non-GAAP forward PE ratio of about a 59, and the forward price of sales is at 8.78. So many of you, especially if you're value investors, you're going to look at this right here and say, hey, it's still too expensive. This would be another one of those long-term investments, really thinking 5 years out. And I want to show you a chart to show you exactly where I think the stock could be attractive to buy. So you can see this stock was $23.63 back October of 2022, and it ripped all the way to $91.57. It's fallen off a cliff. Right now it's at $58. You can see it's holding this blue trend line. It's below the S3 here at $61 and change. It's below the moving averages. It's really below everything. And you're starting to see some buyers here. I really like this stock, especially if you can get it $55 or less DCA, but I do think it's attractive right here. Next, I'll cover stock pick number 4. And then immediately after this, I'm going to show you some buys from community members. This stock really comes down to the fact that I think it's attractive at these prices and lower. I will show you a chart as well. But Expedia's profitability grade is an A. Now, this is more of a mature growth company. You can see only 8.27% forward revenue growth, but Seeking Alpha does have this as an A-. And valuation, this is where I think it's attractive. You can look at the GAAP forward PE. It's only a 13.03. And you can see these PEG ratios are below a 1, and that's what you want to see. Forward price of sales, 1.06. So this is a profitable company with a 9.32 forward PE ratio. You can see the 52-week range, $160.50. The low, $92.48. Now, there are some issues, of course. Expedia fires 2 executives due to violation of company policy. And you can see an article here, leadership transition and strategic growth uncertainty. The stock's a hold. And this is going to be more of a cyclical stock. It's going to rely on travel. If you think the consumer's hurting and the consumer's not going to travel as much, well, this stock could suffer. This yellow circle is really my preference. And you can see this trend line's closer to $100, $101 a share. Another stock that's below all the moving averages, below the Fibonacci's, below the S3 here. It was just $160. Huge sell-off here. These are the type of stocks I look for opportunities. You don't want to buy a stock, of course, at $160. You want to buy it when it's on sale. Now, I think this stock could go lower. I think you could see it even under $100 a share. If it gets below $100 a share, that is my preference, but I like it right here, $110 or less DCA, and I have added a starter position myself. All right, next I want to show some community buys just to give you some ideas. I'm going to start on X, then I'm going to go to YouTube under the community tab. Then I'm going to go to Discord. I'm going to show you what our elite members are buying over the last 24 hours in our Discord community. So real simple post here on X. Which stocks are you buying now? We've got Shopify and Cloudflare last week, Shopify and Axon, Tesla, Apple, Junior Silver Miners. All of them. None, just ETFs. ALV, ASTS. I think that was up like 40% today. So commodity sector looks promising to this person, FCX and URA. Think of adding TECK, DraftKings, Kava, Zscaler, Snow, Baidu, SMLR, and plenty of others. Now this is YouTube under the community tab. If you don't use this, use it more often because I post on here all the time. Considering Dell or Tesla right now. Zscaler, Ultra Beauty, ASTS again, buying Tesla, DOCN and AEHR, ONON and Palantir, Starbucks, Nike, ARCG, AMD, Palantir, Zscaler, McDonald's, SCHD, Workday, Ultra Beauty, and Lululemon. Realty Income, Palantir, and JEPQ ETF, another SCHD, and Shopify, Salesforce CRM, Navitas, UiPath, ACLS, HIMS, NVIDIA, McDonald's, and Home Depot, Hood. We've got Ulta again, Disney, PayPal, and this person also buys ETFs every month, DCA. This is smart, SCHD, QQQ, and VT. If you're curious what VT is, that's the Vanguard Total World Stock Index Fund ETF. And it's one of those funds, it's not going to give you a ton of growth. It's giving you about 10% a year over the last 5 years. But it's a great way to accumulate wealth, diversify, and build a core in a portfolio. Now, these are buys in our Discord community from elite members. Now, if you want to join this so you can see the buys and sells every single day in real time, both my buys for both portfolios, I've got this primary portfolio that's about $2 million. We've got the community portfolio that's just under $100,000. We just started that about 2 years ago. We've already built it to 6 figures. And then these buys here in the investing trade floor, these are long-term investments from community members. So you've got some Snowflake in here, Lululemon, Snowflake, John Deere, Navitas, Snowflake, A bunch of rollover IRA buys, including WCLD, WCBR, Microsoft, SOXX, VU, SPRX, Sky. We got Zscaler, PayPal. And the SPRX one is a good one to look at. That's the Spear Alpha Growth ETF. That thing has absolutely crushed it over the last year or so. And it has a lot of the Fired Up Wealth favorites in it. So definitely check out that ETF again, SPRX. We got Zscaler, PayPal, another Navitas. We got VB, ACMR, SCHD, Navitas, and then IWM. So if you want to be a better investor and you're not subscribed to this channel, what are you waiting for? Smash that subscribe button, click that bell for notifications. And if videos like this are helpful to you, please do me a favor in return. Drop me a like, drop me a comment. Let me know what you're buying. All right, I've got 3 more stock picks for you. Number 5, it's one that you saw several times, people buying not only on X, but also on YouTube and in our Discord community. It's going to be Snowflake. Now, I did drop a Patreon exclusive last Thursday on Snowflake, and it was about 26 minutes, a little bit deeper dive, and lots of real talk. Now, some of you might have been surprised at what I said on there, but I told you just a week ago that the stock was likely going to go back below $150, and it did exactly that again today. Now, long term, I'm still very bullish on Snowflake. I've done several videos on the channel. I encourage you to go take a look at those. I think Snowflake will be a beneficiary to Gen AI when you think of phase 2. So right now you're building up the infrastructure. Stocks like Nvidia, SMCI, and so on, Broadcom, those kind of stocks are crushing it in this environment. We have to build up that infrastructure for AI, and then phase 2 are going to be applications and other beneficiaries that are able to use generative AI in a consumable fashion, and Snowflake fits the bill. It's a consumption-based model. It does have a new CEO. It is an expensive stock. But when I think of 5 years out from now, I think of big data. I think of being able to take your data, siloed information, put that together, and use it in an efficient and effective manner. Snowflake is one of the strongest stocks that you can own, as well as a couple other names. Palantir is going to be one, and then Databricks, which is a private company. Now, if you want to watch that Patreon exclusive, you can go watch it right now, absolutely free. Visit patreon.com/firedupwealth and sign up for the 7-day free trial. That's a free trial to Elite, no strings attached. Go watch the video right now. Now, ever since Snowflake went public with an IPO in 2020, we said don't be surprised if this stock is below $150 at some point because it's very expensive. You can see it went public for $240 back September of 2020, ripped all the way up to $387. The very peak here is almost $400 a share, now below $150 at $149. If you bought this the day of IPO almost 4 years ago, you're down almost 40%. It's down 6% in the past year, and it's down over 21% year to date. $150 has been the price point to dollar cost average, $150 or less. Now looking at this, the S3 is all the way down here at $134. Last earnings report wasn't bad, but it was mixed. You remember it did miss on the top line. Buyers generally seem to want to come in around that $145, $150 level. You've seen that a couple times here. But remember, not that long ago, December of 2022, this was a $119 stock. In fact, it was $111 after hours. So I like Snowflake, $150 or less DCA, but you probably have to buy this as a spec stock. It is expensive, it's high risk, and I wouldn't be surprised if the stock was below $125 at some point. It's very possible. In 5 years, I think the stock will be worth quite a bit more, and I think $150 or less DCA is a good long-term investment. Now, I admit I do struggle with this stock a little bit. Lululemon at $300 a share. You know, the 4P ratio is at 21, though. The risk here is the consumer. If the consumer breaks down, they're not spending as much money, that Lululemon might not do well. There's also talks about how Lululemon's losing market share. People are going to other brands. We have some folks in our Discord community that are from Los Angeles saying that it's not as popular. So there's definitely some risk to this stock. You know, this is one of those that's more of a mature growth type company. You know, forward revenue is about 14%. The valuation, you know, looks pretty attractive when you look at the P ratio of 21 in these peg gaps. So you've got an A profitability, you've got a growth of about a B minus, and valuation wise, I mean, is it expensive or not? You know, I look at this, I look at that 4P ratio of a 21. It seems reasonable. You know, this stock is up 72% over the last 5 years. And you can see this was a $516 stock and it just fell off a cliff. Now going back in time here, May of 2022 is $250. It doubled over doubled to 516, and now it's down here. Now this S3 is at $298.35. It's trading right around that right now at $299. I think it's possible that it could drift lower. I mean, I think you could see this stock, maybe even 250 to 275. That's certainly possible. But when I look at what's out there, a lot of expensive stocks, I mean, this one is fairly attractive, under $300 DCA, but understand there are some risks to it. Now, earlier I talked about beneficiaries of generative AI phase 2, and we talked about Snowflake. The next stock, pick number 7, is going to be Palantir. Now, I have a ton of videos on the channel about Palantir, so if you want deeper dive due diligence, go take a look at those videos just from a real high level here. I don't love Palantir at $20 a share because my cost basis is much lower. But the reality is this: the stock has grown into itself. It's certainly not a cheap stock, but looking at this, if it gets to under $20, $20 or less DCA, this S3 is $18.60 or so. And this 200-day moving average is 19.24. Right now it's holding this trend. I do think there's a good chance it breaks 20. I do think that buyers could come in under $20. My preference on this stock, just to be completely transparent, to be real with you, my preference is $15 or less, but I don't think it's going to get to 15 unless something catastrophic happens. And I think there's a chance this will be listed on the S&P 500 and the stock could go higher. So if you can get this under $20 a share, I think it could be an opportunity as a long-term investment. As always, thanks for watching. Thanks for the support. Make sure you subscribe, like, and comment. Have a great rest of your day. Take care.